Are you wondering what in the world a hard money loan is anyway, and if it makes sense to use one as a real estate investor? In this video, I'll explain exactly what a hard money loan is, what the pros and cons of a hard money loan are, and when it makes sense to use them, and what to watch out for. So essentially, hard money lending is a type of financing in which the borrower receives funds from a lender in exchange for that lender receiving a lien on the property as collateral. And the lender is typically a private individual or organization rather than a traditional bank or financial institution. That's the distinction here. Hard money lenders are not big banks. And it's called hard money because the lender focuses on the collateral or the hard asset, the property that it's using as collateral. I've also heard it said that it's called hard money because the terms are expensive, which is true, but more on that in a second. Okay, so now let's discuss the pros and cons of a hard money loan as compared to a traditional bank that you would have in the area that the property is in. So one of the big primary advantages of a hard money loan, the pro, is that they are quick. Unlike a traditional bank, they can close within just a few weeks. There's not this 30, 60-day process that maybe they'll close. A hard money lender's advantage is that they can and will close quickly. Secondly, is they can be a pretty easy process, especially once you've done the first loan with them. The subsequent loans can be super fast. And third, there potentially may be no appraisal. It kind of depends on the lender that you're working with, but the lenders I like to work with the most, they do not require appraisals. They do an underwriting process, they do their own internal appraisal, but they're not sending out a third-party appraiser. And another really good advantage of a hard money lender is that they are focusing on the asset more so than you as the investor. So they're not typically running a credit check, and they will lend up to the full purchase price plus the rehab so long as it meets their loan to value ratios. So I've had lenders that will do 100% of the purchase price plus 100% of the rehab. Now there are some that have rules that they'll only do say like 85% of the rehab or 90% of the full purchase price, but that just depends on the lender that you're working with. Okay, let's move on to the cons of a hard money loan or getting a hard money loan from a hard money lender. And one of those is that they are typically very expensive. They can charge pretty high points and their interest rates are much, much higher, sometimes twice as high as what you would get from a traditional bank. And second is that the terms of the loan can be fairly short term. They're typically 6 to 12 months, maybe in a few cases as long as 2 years, but that's the exception. 6 to 12 months is what I've seen the most often. And the third one is that they may not be in your area. Some of the lenders that you're working with are kind of regional niche type lenders, and they don't invest or lend wherever you happen to be investing. Now there are a few quite large hard money lenders that will do nearly every state, but they tend to charge appraisals and they're a little bit slower. They're not quite as easy. And the fourth con here is that they sometimes require experience. This depends again on the specific lender, but a lot of times I've found they don't want to be your first loan. They don't want you to be, you're doing your first deal and they're seeing if you can make it. They want to see that you have a history because they don't want to take any risk. And lastly, the loan to value varies. Can be anywhere from 60 to maybe 80, sometimes 85% if you're really lucky. But for the most part, I've seen lenders, they stick to 65 to 75% of the loan value. And that's for the full purchase price and the rehab. Then they do an internal appraisal and figure out what the value of the property is. And then they will only lend up to this point. So they may lend 100% so long as it's less than 75% of your loan to value. Okay, now that we know what the pros and cons of hard money are, the question is, when is a good time to use hard money? And if you don't have a lot of capital to deploy or you don't want to tie up your existing capital and you have a really hot deal that needs to move really quickly, that you have a quick close time, then that's when it makes sense. Let me know if this particular scenario sounds familiar to you.
Hello, this is Paul. How can I help you? Oh, yeah, okay, yeah. Oh, so you're ready to do the deal, are you? 150,000 will work for you. Oh, but we have to close in 2 weeks. Okay. Yeah, I'll send the contract over right away. We'll close in 2 weeks. All right. Yep, we can do that. Have a good day. Bye. Yep. All right. Yes. Hey, honey, do we have $150,000 anywhere? I need to close in 2 weeks.
Okay, yes, that's really good news, right? You just got the deal. So that's when maybe a hard money lender makes sense. You get this screaming hot deal. There's a ton of equity in the deal, but you need to close like in 2 weeks. And if you have a good hard money lender that you've used before, then you can close in 2 weeks and you're in business. So let's run through an example over on the whiteboard. All right, so let's walk through an example based on the phone call that I received for the deal that I could buy for $150,000, and I need to close in 2 weeks, but I happen not to have the 150 grand to close on the property, much less the 50 grand to actually buy to do the rehab. Okay, so the purchase price is 150, the rehab cost is 50,000, and so I've applied for a total loan of $200,000 from a local hard money lender that I'm familiar with, and he'll do up to 7% loan to value. And the value of the property we agreed to is $300,000. So I'm at 66% there. So 2/3, 66%, I'm within their qualifications. So they will give me a loan for the full $200,000 because we've done business together before. And so he charges 12% and 3 points. Remember 12 and 3, 15 and 5. In this case, it's 12% and 3 points. So 3 points on $200,000 loan is $6,000. That's 200,000 times 0.03 equals $6,000. And then the rehab and selling of the property took me 6 months. Let's pretend in this example. So I held the property for 6 months and I had the loan out for 6 months. So 12% on 200,000 for 6 months is $12,000. So 12% of 200,000 is in 1 year is $24,000. One half of that is $12,000. So that's the interest that I paid during the 6 months. And so when I sell the property, I sell it for $300,000. And so let's say that there's 10% in closing costs, transaction fees, and realtor fees, etc. So my net from that is 300,000 times 0.9 to give myself 10% discount of all the fees. And so I'm left with $270,000 of gross profit, but now I need to take out my holding cost and my loan value. So I've got to pay off the loan of $200,000. So that's 270 minus 200, that's $70,000 in profit before paying fees. So if I take out the points I paid and I paid out the interest I paid, I made a net or a gross profit before taxes of $52,000. That's the 70 grand we just had minus the $18,000 in fees gives me about $52,000 in profit before I have to pay my taxes at the end of the year. So not an all bad deal. Let's say plus or minus $3,000, $4,000, $5,000. Would you do a hard money loan with these terms? Would you pay 12% interest to make $52,000 if you didn't have the capital? Even if you did have the capital, would you borrow this money so that you could take down the deal and keep your cash on the side? Maybe so. Even if this interest rates were 15% and 5, you can run the numbers at 15 and 5 and you make $45,000. So it's an important lesson to learn that just because you're paying 12% interest, just remember you're doing this to buy an asset that's at a discounted value. So it only makes sense if the property is really worth $300,000, you really have the capacity to do the rehab in 6 months, and the market really is going to buy it for $300,000, and the $150 sales price that you bought it for really was a discount, and $50,000 forces the appreciation to make that property worth $300,000. Okay, so now that we know what hard money is and when it makes sense to use them, let's discuss what to watch out for when using hard money. And of course, this is scammers you want to watch out for. There are a lot of completely legitimate hard money lenders out there, but there are folks that are acting like those hard money lenders or are pretending to be a hard money lender, and they are out to get your money without actually lending you anything at all. The general approach that scammers take is that they want some sort of upfront deposit after you put in your application. And that is a really big red flag because you don't need to put out $1,000, $2,000, $3,000, $4,000, $5,000 of a deposit for someone to then lend you money. That's a huge red flag to watch out for. Now, there are times that legitimate hard money businesses may ask for an appraisal fee, or they may ask for a loan lock fee, but this is usually in the order of a few $100s, typically less than $1,000. And these are from the really big financial companies that are really well established and that you can go and look and find people who've done loans with them before. Smaller hard money lenders tend to not do that. I'm a hard money lender myself, and I don't ask for a fee up front. Another scam to watch out for is that there are these businesses that are like legitimate lenders, I guess, but they lend on terms that are loan to own. The terms they're offering you are so hard to pay back that it's unlikely that you will be able to pay them back. And what they're doing is they're setting you up to basically scoop your deal. They see that you have a really hot deal, lots of equity in it, and you're in a desperate position to get some sort of funding to take it down, and they offer to step in and kind of rescue you, and then they create terms that are such that it's unlikely you'll be able to pay them back, and then they foreclose and take the property from you. So the way around that is that anytime you're working with a new lender, that you want to see their loan documents and you want your attorney to review them. And when you go to closing, make sure that you're signing similar documents to what they've sent you before. So if you have a good deal and you need to close fast, then hard money might be a viable option for you. Just make sure and watch out for the things we talked about. I'll drop a link to some lenders that I've used before in the description box so that you know that they are legitimate companies. And if this video was helpful, make sure and like and subscribe. And if you want to learn more about real estate investing, I'll make sure and leave a video for you right here.